am I drawing this line correctly? Or what about this one? Or this one? The thing is, no one actually knows. That's because trend lines are drawn according to each trader's interpretation, and as a result, it's susceptible to human error. And the more you can reduce human error in your trading, the more profitable you will be. In this video, I'm going to explain to you why I've completely stopped using trend lines and the type of lines I use instead. These are much easier to draw, much more reliable, and cannot be misinterpreted. So what's wrong with trend lines anyway? Look, I'm not saying you can't be profitable trading a trend line strategy. You can, and there are plenty of traders who are, but practically every trading strategy, even the most absurd, can be profitable providing you trade it the right way. Sure, if you nail the timing of a trend line breakout, you'll be able to enter a trade earlier. However, the vast majority of traders who use trend lines are not profitable, and one of the reasons is because trend lines are just confusing. I stopped using trend lines over a year ago, and as a result I've taken less losses and have improved the probability of my setups. So why did I stop using trend lines in the first place? Well, I only trade to the long side, so my trend lines were always sloping downwards and I'd play breakouts to the upside. Using this as a basis, here are several major reasons why I stopped using trend lines. Number 1. Trend line angle and length. Ask any trader how steep a trend line should be and you'll get a bunch of different answers. Some will play breakouts from really steep angles, while others will only consider trend lines that are almost straight. There's no conclusive angle where you can say, yep, this trend line is definitely angled correctly. To add to the confusion, you have to take into consideration the length of the trend line. Now typically, the longer the trend line, the more reliable the breakout should be. But that just means that there's more resistance to the left to fight through, which leads me to my next point. Number 2, overhead resistance. Draw a trend line on any chart and look to the left of it. Everything above the trend line is resistance. These are trap buyers that are potentially looking to sell at or near the entry point. That's why you see so many trendline breakouts fail, because by nature, price and momentum is to the downside, and it's more likely to continue its downtrend instead of shifting. Compare that to a horizontal resistance line where if price breaks out over it, all the buyers below it are in profit and are less likely to sell. Everyone's happy, or at least they should be. Now the last reason, and probably the most confusing of them all, is number 3. Trendline touchpoints. It's not very often you get a perfectly drawn trend line where price touches all the upper points to the T. Sure, you can probably go back in time and find some picture perfect trend lines where price just obeys the line, but that would be looking in hindsight. Try this in real time and it will turn out very differently. In most cases, when you begin drawing a trend line based on 2 touch points, what you'll see is that price won't respect it and it will usually poke its head through the trend line and dip back down. Then you start thinking whether you should move your trend line or draw another one that layers over your existing one. I eventually came to the conclusion that trend lines were just too confusing for my liking. During this time, I was still unprofitable, still trying to figure out my strategy, and still trying to simplify my trading. And one of the things I did was get rid of trend lines altogether and instead focus on a different type of line that was much more reliable. It's not a secret what type of line I'm referring to. As a matter of fact, you already know what it is. I'm talking about horizontal support and resistance lines. These represent the floor and ceiling of a price where it's hard to misinterpret. However, that doesn't mean you're going to be profitable simply by buying a breakout or a breakdown over a horizontal line. There are many other factors that make a profitable trader, which I'll cover in another video. But I will share with you some incredibly useful tips that will increase the probability of your trades when it comes to using horizontal lines. Once again, since I'm a long only trader, I'll use horizontal resistance lines as an example. So the first tip I want to share with you is, number 1, draw the line over the majority of resistance. Resistance lines should be called resistance areas because more often than not, there won't be an exact price that will act as resistance. It'll be a bunch of different prices around that area. For example, you might see a price hitting a ceiling multiple times, around $80. It'll reverse at $79, $79.5, $81, $82, and you're wondering which price to use as resistance. Well, in this case, I draw the line over the majority of resistance, and if the candle wicks up and touches $82, but all other resistance is below $81, then that's where I draw my line. So using Amazon as an example, we have $190 acting as resistance, which is also its all-time high during this period. On 5 separate occasions, price hits this area before reversing at $189.77, $189.94, $191.70, $188.35, and $191. In this case, you can determine that resistance is at $190, and despite it breaking above this price twice, it doesn't close above it. You can say to yourself that if price breaks above $190 again, and on decent volume, it has a good chance of continuation. This time, the price does close above $190, but it doesn't go very far, so you'd probably be stopped out at break even or taken a small loss if you took this trade. My next tip is that tightening price could lead to an explosive breakout. So using the same chart as an example, you can see the higher lows forming and price tightening up before the breakout, essentially creating a wedge pattern. This just means that buyers are supporting the stock and are gradually driving the price higher. Of course, this breakout on Amazon fails, so let's take a different example. So during the latter part of 2020, Tesla was having trouble staying above $155. This is where I set the horizontal resistance line, since it's above the majority of resistance. Price does break above it very briefly in August 2020, but then reverses. Now, if you look to the left of the chart, there's literally nothing but clear skies. There's no resistance to fight through. You can also see a set of higher lows forming and price tighten, creating yet another wedge pattern. Then on 18th November 2020, there's a breakout over $155 on decent volume, followed by a multi-month rally. There are literally thousands of examples that show tightening price action, followed by a breakout over horizontal resistance. So my third tip that further validates the importance of a horizontal resistance line is that the longer the resistance is, the stronger the breakout will be. Think of a stock that has a long resistance level as an active volcano that's been sleeping for a very long time. Its magma has been bubbling beneath the surface for so long that when it finally erupts, it's extremely powerful. Buyers have finally taken control and are willing to pay a higher price for the stock. The reason is usually due to a catalyst like earnings, a new partnership, or it could be simply a case of demand exceeding supply. I like to see stocks breaking out over at least 6 months worth of resistance, but preferably 1 year. Stocks that break out or gaps up over their all-time highs should be paid close attention to because obviously there's no resistance above. Let's take a look at a few different examples. So from January to December 2022, biotech stock VKTX mostly stays below $4.50. There's a bunch of buyers holding on to the stock for nearly 1 year. Then on 19th December 2022, the stock gaps up around 35% on huge volume, and it makes an impressive rally, more than doubling its price in less than 2 months. It was a sympathy play based on another drug maker's successful clinical trial. Next, we have Reddit, which IPO'd in March 2024, and for the following 6 to 7 months, it was pretty up and down, barely breaking its all-time highs a few times before reversing. Now, it wasn't until 30th October 2024 that there was a definitive move. The company posted surprise earnings, and as a result, it had a big gap up over all-time highs on huge volume, the second highest ever after their IPO date. I did play this gap up, but unfortunately I sold it far too soon and didn't take advantage of this rally, but that's a story for another day. And the last example we have is the natural gas company Targa Resources, TRGP. For a long time, mid 2015 to the beginning of 2024, so 9 years or so, the price stays below $90. And since COVID, it made a crazy move from around $4 to $80 within 2 years. But it wasn't done yet, because for the past couple years, it's been up and down, and sideways. Then on 15th February 2024, it had earnings and it finally breaks out on decent volume and makes another massive run without ever looking back. There are so many different examples of big breakouts over long horizontal resistance levels, and you won't have trouble finding them at all. So to conclude, horizontal resistance lines or areas are easier to identify and have a higher probability of follow through, especially when they're combined with a catalyst and huge volume, at least in my experience anyway. Let me know what you think about trend lines and how you draw them and trade them. And if you enjoyed this video, just hit the like button and subscribe to my channel for more swing trading tips. See you in the next video.